Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter. We're going to look at some information on what's being released by those on Twitter. And it's mainly commodities and stock market related stuff. Every once in a while I'll get into real estate and all of that. So if you want to follow me on Twitter, it's at finding_finance. I retweet a lot of stuff. And again, if you need any help with anything in the bull market, commodity related, check out finding-value.com. That's this guy right here. And become a platinum member using the word discount for the coupon code if you want a discount. Join our community. All right, so coming on down. Yeah, I did an interview with Justin. Posted this chart, latest backtest of black support line. I think it is time to revisit the upper trend line of the channel, repeating the move from 2000 to 2007. This is Huey. Huey is the gold and silver gold bugs index. That was last bull market. I think we are going to have another run higher. I agree with him. And I'm actively looking at potential investment opportunities in this general vicinity. I am actually moving up the risk curve a little bit in looking at some of the small junior gold and silver mining companies. I've already got a good weighting to the mid caps and royalty companies. But this could be a gigantic move, guys. I mean, this was 650 on the chart here, and we're going to blow past that to the upper trend line here if it were to do that. I actually think there's a good chance. I think this is going to be like the 1970s. We've got a broken out interest rate environment, and that is far different than what it was in the 2000 to 2007 regime. Money is going to be flowing out of bonds and out of stocks at the same time looking for a home, and I think this is one of the potential homes for those investments. So that's a Huey. We've got Andy Scheckman here. Let's go precious metals family. Gold going back up. And it closed quite high. It was 1900 and something. 19 something. Here's platinum. This is from North Star. Platinum analysis says this does not guarantee a large upside move. It does tell you there's a perfect setup for a large upside move. This will become a high probability if price passes through the wake-up line. Here's our wake-up line. It's right there. We've got good momentum going into that resistance line. I don't see any reason why it wouldn't break it. We've got confluence with silver and gold. Gold moving on higher already. Silver looking like it wants to break as well. So I think platinum's going to do very well. Says no bias, no narratives, just scientific evidence with every chart analyzed equally. Oh yeah. We've got commodities still looking solid with the falling wedge, and hopefully we get a break higher here. This is our 1, 2, 3 hump. And then you get a fourth. This is a lead-in pattern for the next move. Sometimes this fourth hump happens within the pattern. Sometimes it happens outside of the pattern as doing a retest. So that's looking fantastic for a move higher for commodities. And that's zoomed in on them. Nice little falling wedge that we're breaking to the upside. I said gold continues higher while silver consolidates and platinum does a retest. There's gold taken higher. It actually finished higher than this. I posted this early in the day. Silver actually broke out of this little pattern here. And then platinum was doing a retest and it actually ended back up. It was a small little candlestick. So all of them are looking very good from a precious metals perspective. I am very much bullish on precious metals right now. Very big bull. Now, natural gas is getting cheap again against crude oil. I will be watching for a bottom out of natural gas and a potential investment. Keep in mind that oil looks good to break higher. Gold to oil ratio still cheap at 24. So we're at 20. Yeah, so this is the crude oil to natural gas ratio. It's at 22, which is pretty cheap. Anything below, I'd say where this line is very expensive down here. This is pretty cheap up here. So natural gas is cheap to crude oil. And then you look at crude oil. Crude oil is actually breaking out of its falling wedge, and it did break out last trading session. And then we've got gold to crude oil. So that's a gold to oil ratio. And we are actually very cheap at 24. 1 ounce of gold can buy 24 barrels of oil. And that's incredibly cheap. Incredibly cheap. A huge buy point for me is around 30, where that is basically you're scraping the bottom of the tank. 24 is still incredibly cheap. We have a long way to go in terms of valuation run up in oil and even natural gas. And I know natural gas pulled back. We've had some weather over in Europe and America be on the warmer side. It's going to happen. You can't control the weather, guys. But opportunities are there. Now, here's one of my favorite sectors right now. Energy service companies still look fantastic and are outperforming a lot of other sectors. Probably one of the best sectors to be fishing in. Need help finding companies? You can sign up to the membership. Yep. Really low against GDX. Now, GDX is low against a lot of other sectors. OIH, the energy service companies, is cheap to GDX, and it's moving in a positive way. It's gaining value against GDX. I also think GDX is going to do very well. I think energy service companies are going to do very well. I think those are two good sectors. OIH versus the rare earth metals ETF. OIH has broken its downtrend and starting to move higher. You've got that stair-stepping pattern where you get large up moves, small pullback, the bloody nose type movements. You get OIH versus XOP. That's broken to the upside of a falling wedge. OIH looks to outperform XOP. And then OIH versus SILJ. SILJ is very cheap, and we've seen a vast outperformance here of energy service companies moving to the upside. And I think that will continue. We're still on a low, cheap end for energy service companies, even against SILJ. And there's a lot of different individual companies in energy service companies that have not moved yet that are putting in bottoming patterns that look fantastic for potential investment. Absolutely fantastic. So yeah, I'm definitely fishing there, getting those companies. And I'm loading up a portfolio of a lot of these companies in the sectors, individual companies. And we've had some really good success with some of the energy service companies, up 2, 3, 400% in 6 months. BOJ losses control of bond market as new yield curve control band breaks amid selling panic. What happens next? Well, if the BOJ is unable to restore confidence to the bond market, the Fed may have to restart QE to avoid a bond market rout. Worth watching. They said that they were going to hold their bond market at about 0.5. They're failing to hold it up there. So they're printing copious amounts of money to try to hold their bond market together. Now here's Realtor.com, Freddie Mac, and Moody's. The U.S. is short the house. This is for housing markets. 5.24 million homes according to Realtor.com, 3.8 million according to Freddie Mac, 1.7 million according to JBRC, 1.6 million according to Moody's Analytics. Now, when they say that they're short, that means that they have to build the average home and they have to build this amount above the average. So if the average is 1.3 million, let's say, or 1.4 million, they need to build 5.24 million homes above the average to catch this shortage back up. That is a ton of homes. That's going to take years. Now, if it's 1.6 million, that's going to take maybe 5 years or 6 years. If it's 5 or 6 million, that may take a decade. And what that is that's the runway of credit growth out there for us to go into a construction cycle to build these new homes. We have a long way to go, guys. Morgan Stanley, it says, Morgan Stanley, the U.S. is structurally short 2 million housing units. That's based on conservative assumptions. When they plug in aggressive assumptions, they calculate the U.S. is underbuilt by 6 million units. This here is the structural deficit that is going to drive a commodity bull market, and it's going to take time. Right now, the affordability, the interest rates, in my opinion, are the issue. And once they perceive that they have inflation under control and they lower interest rates a little bit, it's going to kick the housing market back on. If they don't lower interest rates, we're going to see a period of lull, and then I think we're going to see an uptick in real estate again. It's just going to take some time as people readjust to higher interest rates. And when I'm talking about real estate and home builders, the home builders look bullish here. This is XHB. This is the ETF for home builders. We've broken out, we've done a retest, and now we're starting to break out to the upside again. And that is the bigger picture view. We kind of consolidated all the way in 09. We did a recovery phase here. We broke out, and this is our, I think, the lull in the mid-cycle. It happens right when you go into an expansion phase. It kind of get this lull. It's the pullback, and then you're going to rip it to the upside. Here's Leonard Corp. Big move higher, the consolidation from 2005 onward. And then we broke to the upside, classic retest. And now we're moving on higher again. So that's the home builders. And I know that's an unpopular opinion, being a contrarian there. It says new, Bank of America puts the U.S. housing shortage at 4 million plus homes. We believe underbuilding over the last decade has absorbed the 2 to 3 million home glut from pre-financial crisis. Overbuilding and created a deficit of 4 million homes, writes Bank of America. Coming on back, DNN looking like it's going to do a launch, going to launch fest there. But that's kind of what I've got for today, guys. That's what I'm looking at. The real estate market's really important. Knowing that you're in the middle of a construction cycle is a big deal because that is what drives liquidity into the system. That's generally when a commodity bull market happens, is when a real estate market is in an expansion phase. We're in an expansion phase. It's just delayed. Interest rates and the affordability. Now, I thought interest rates weren't going to get as high. I should say, I didn't think mortgage rates were going to get as high as they did. I thought they were going to go to like 4 or 4.5%. I think the housing market can sustain that. It's moving as fast as they did, all the way to 7%. It obviously didn't do as well. So yeah, I got the interest rate portion wrong, but I didn't get the housing cycle wrong. We're still in the middle of a expansionary phase. We still have to construct a lot of homes to right this shortage or deficit. And it's just going to take some time. So that's what I've got for today. If you guys like the content, give me a thumbs up, subscribe to the channel if you haven't, and we'll catch you next time. This is Finding Value.